Shabang, ladies and gentlemen. I'm Hiral Datia. We have with us Mr. Swarup Mohanty, CEO at Mirai Asset Investment Managers India, joining in. Welcome to the show, Swarup, and always a pleasure to speak to you and get insights from you. Swarup, lots happening globally right now as well. From central banks going ahead and increasing rates, looking to squeeze out liquidity, with what's happening with the OPEC as well in terms of crude. And if you see in terms of, Ukraine, Russia as well, China is under the woods. How are you seeing the global situation right now?
Yeah, Hiral, thank you so much for having me. Always a pleasure doing this with you. Yeah, it's a very interesting time right now. I think the last time we saw something like this was probably 2008, 2009, when the entire globe was sort of affected. There are two large events, and the best part of it is everybody is aware of these two large events. The COVID sort of shut the entire economic cycle globally. I don't think that's ever happened ever in the world, that the entire economy of the world shuts down. And then you follow it up with a war. So when you see this happening, there is a significant impact, and the central bank comes into play. And globally, when you look at the central banks playing, the interest rates have gone in a very different direction due to the oil impact. And of course, you cannot take away the impact on the various currencies of this. And when there is a turmoil globally, there is always a flight to safety from the monies of the world to the dollar. And then we see that happening as we speak. And hence our markets have been impacted by the outflows more than the fundamentals of the market. It is very interesting to note that from a fundamental standpoint or data point standpoint, India stands out globally, which is so good to see. I mean, our data points are probably one of the strongest I've seen when it comes to relative global data points. But the fact remains, because of the turmoil globally, the flow of money will be impacted, and hence the volatility is there. But due to the information flow being so strong, I think the investors are holding firm, and India data points being good, the Indian investor is behaving quite well, and hence these are very interesting times to watch and play in the global scenario as asset managers.
Right. So overall, how is the mutual fund industry actually viewing the overall market scenario? Do you think we will start seeing, redemptions from here on, or do you think this is the best time to stay invested?
Viral, the beauty of the equity markets is it is contra every day. A trade happens because you have divergent views. If I am a seller, there is a buyer in, and the views are actually opposite to each other. And that's on a daily basis. And when you project it to a situation like this, the views will start differing even more. And everybody is entitled to their views because, people are qualified to take their views as per their risk profile and their money situation in their lives as investors. As asset managers, we continue to be constructive of the space because of the data points that India proposes. I mean, the consumption data points from, say, power consumption to two-wheeler consumption is there for everybody to speak. And 2 years post-COVID, it is no longer a thing which we used to say that the base was low. The base is also growing. So with the consumption remaining intact, our view of approaching the markets were more to start with COVID than the war situation. Our view is that, you cannot take away the impact of COVID on some of the mid and small balance sheets. So one has to view that a little more, with larger lenses than earlier. And there could be consolidation in that space. Post-COVID, it is definitely advantage large companies. And in turbulent times like this, for us, it's a flight to safety, you can say, because we are in favor of large companies. And when you've had this kind of exit of FIs in the top 50 companies of the country, it is quite natural that the risk reward on the flow back of that money is in favor of larger companies. So it is a good time to hold them. We always advocate remaining invested in the market, irrespective of turmoil or volatility. In volatility always lies the opportunity, and that's something which fund managers seek to, gain from. So investors should do that as per your risk profile. The basic that one can do is staying invested, and that we are seeing through the SIP route. I can dare say that I'm not seeing on the lump sum purchase route where we are seeing redemptions. That's the reality. And then nothing wrong, take some money off the table is something which the Indian investor has practiced. So I'm not the right person to judge that behavior. It's as per the risk-taking profile of the investor. But it will be prudent to see this phase through by remaining invested.
Right. So, when you say remain invested as well, is it the time to play safe? Because if you see the mutual fund data trend as well, it's clearly evident that, mutual fund managers are playing it safe by staying invested mainly in the safer blue chip stocks to tide over the volatile markets. And it's best to stay away from mid caps and small caps.
See, I think when you look at us as a fund house 1.5 years ago, we had given a call on the mid caps. I think our view, because people were, let's face something, people look at near term returns to allocate, and when the near term return of mid caps were glaringly high or above normal, people tend to allocate more, and that's something which we had cautioned the market. But as we speak, some of the valuations on that side is looking good, and one should start reallocating is our basic fundamental view. But there is no doubt or debate that there is still a lot of uncertainties in the market, and hence the flight to safety, right? Fundamentally stronger companies, larger balance sheets can weather this storm. Because how long this storm will elongate is, anybody's guess. The war is just not ending, and it's leading to complications by the day. Some of the data points of US is something which is at a 4-decadal high. Their interest rates and their inflation is something which this generation probably has not seen. So when something happens in the US, the impact is always on the rest of the world because the world trades in dollars. So one has to keep that in mind while investing. At the same time, one makes money by allocating, one loses money by over or under allocating money. So stick to allocations. Don't switch allocations. If your mid cap investing requires this much of percentage allocation, then stay invested. Don't tinker with that. Is a very prudent advice, and that's something which a pretty great investor does. We do that at the fund end also. It's not that our mid cap fund will start investing in large cap stocks. That will not happen, irrespective of the rules of the game. But be true to your portfolio and remain invested is the basic mantra of investing, which one should follow.
Right. So with all of this said and done, I know, it's a lot of word on the street right now with concerns arising with major banks like a Credit Suisse or a Swiss bank or a Deutsche Bank. Yes, there are rumors, that probably the European banks are under critical stress. What's your view on it? Because in turn to it, the Indian banking system is probably on a much higher note. In fact, is out of the woods and in a place that we've not seen probably years ago.
Yeah, Hiral, at the beginning of this discussion, I said when you look at data points of India, it is contrasting that of the world. And the banking system is something which we've been highlighting for over 1.5 years. That, banks today are standing on a very different wicket to what they were before COVID. And hence, there has been a very strong call on banking, and most of our portfolios are overweight banking. But when this war elongates for a longer time, the impact just starts deepening, and that is what is being seen globally. And the underlying economies, whether it's the US or the Europe, are definitely going through very trying times. When this will end, or to what extent that the impact will be, is something which at this moment very difficult to sort of answer, because there's no end to the war, right? And more it elongates, the impact on oil and subsequent impact, I'm told, on Europe through electricity is also beginning to play out. I just read somewhere that the electric vehicle charging charges is almost equal to petrol now. So that's a special situation. So we'll have to wait this one out to find out how or deep this impact will be. The impact is there, make no mistake on that. So that's what will give some opportunities, especially for people who were looking at global investing. I think it's a good time to start looking at those spaces, and it's a good time for investors. I feel investors are spoiled for choice. If you look at Indian markets are doing well, global markets being in turmoil. Some of these stocks in US today are available at some very attractive prices, and if US fails, then the impact on the rest of the world is known to us. So when the US market is number 3, number 4 on a global index level, it throws up its opportunities. Our debt, on its yields are looking very attractive. So I feel at this moment, an investor is spoiled for choice. If one just prudently approaches this market in a very unemotional manner, there can be very good entry points at this moment.
Right. But do you think, God forbid, anything happens with a Credit Suisse or a Deutsche Bank, will that be as bad as what we've seen during Lehman?
See, I think when you look at what happened in Lehman and that time, 2008, 2009, was unprecedented. See, in every crisis, after the crisis, the world moves on. We've seen that happening in India also. We've probably seen some of the toughest credit phases in India. And it's not that the world came to an end. If this would have happened in 2000, 2008, 2009, the impact would have been larger. Yes, there will be some casualties, may or may not be, but I think the markets are far more resilient in the way they've learned how to, take this within the stride post 2008, 2009. And it's not just about this. Any crisis has a start date and an end date. Next time the crisis happens, the world has already moved on. Look at, it's not that COVID is gone around us, but we're leading our lives now in a far more informed manner than we were, say, 2 years ago. And that's how it will be.
Right. And overall, so right now, if you say, probably this is the best time and an opportunity that investors should use to buy stocks and dips and continue to accumulate as well to build their portfolio. So what are the sectors that you would advocate right now? Because clearly, again, IT, pharma, export-oriented sectors, people are worried of because of what's happening globally. But again, do you think FMCG, IT still could remain the safe havens today?
See, this is a personal opinion. I think IT, a lot is being discussed, but I think IT infrastructure will be rebuilt again. I mean, the demand or the requirement for IT is become so large, and especially we've seen the tech upgrade in India post-COVID is incredible to see. So hence the setups or the infra requirements in IT will be redone is a very personal opinion. We are seeing that happening in all our lives, in all our businesses. So projecting that to other businesses, it will be rewritten again, and we will see a very different approach to IT going forward. That's point number one. Point number two is what we discussed earlier about financials. I mean, today Indian financials are cleaner than what it was 2-3 years ago, and some of the balance sheets are looking far more attractive and stronger than it was, say, pre-COVID. So that's a sector which we really look forward to, and we are overweight that sector. Let's be very honest on that one. The third part is I do believe healthcare is perpetual from here on, and it will just not be restricted to pharma. Pharma will go through its churns of various companies going through these ups and downs, but healthcare broadly and post-COVID is a reality. So that remains there. We see a structural revival in housing, and that's happened recently. And today, if you see, in spite of the interest rates on home loans going up, September last month saw the highest registration of houses in Mumbai, and Mumbai is basically the indicator of housing in the country. Consumption is back, and consumption, one can say the base was low, but the base is becoming bigger. But one is really surprised to see the sustained continuation in consumption. And the good part is, from an investor perspective, post-COVID, they have differentiated between what is want and a need. And there is a differentiation for the first time, I must say, from the analysts from what is a consumer staple and what is a consumer durable. I mean, there's a clear demarcation, and one will start approaching, investing in that regard. Some of the new age businesses continue to be a suspect, so let's see how that plays out. But broadly, from the core of the portfolio construction, India looks okay, and it'll be a little wait and watch at this moment from the smaller balance sheets perspective, but the larger balance sheets are looking quite strong.
Right. And very lastly, Swaroop, in terms of the RBI, we just had the RBI policy as well. Do you think they are being too optimistic about India's growth? Because clearly they're expecting inflation to come down to 5.2%. How do you expect that side of the story? Because once we hit a peak, the way the global markets are looking, do you think we will have to see a reversal happening in terms of cutting rates again, pushing out liquidity? Do you think that situation could arise?
So this situation is so uncertain that all possibilities are there on the table.
Hmm.
I have, in my capacity as a student in this industry, have always maintained that our central bank is one of the smartest globally, and we saw that playing out during the COVID phase. I think when you look at our interest rates and our inflation, I think it's been handled quite well. At this moment, the challenge is more on the rupee side than on the interest rates. It's my personal opinion, but I'm pretty sure the central bank will be always up to the task, maybe a little ahead now. It was being accused of being behind the curve. I think that they have put it very efficiently behind, and at sometimes, when you're watching it, it's always good to be a little behind the curve. Our view on mid cap could be the similar thing. I'm just correlating the two, in the sense we might be okay in catching the rally one day late,
Mm.
then take the risk of the downside there. But I think at this moment, you can't say that there is one path for sure. The uncertainties are so large that anything is possible. One has to take it one quarter at a time, is the way I view.
Absolutely. I think that wait and watch and act, slowly, steadily is something that's an approach that we should be looking at. But thank you, Swaroop, so much for joining us on the show. It's always a pleasure to speak to you, get insights from you. Thank you. Stay safe and speak to you soon again.
Thank you so much for having me. Always a pleasure.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.